Distinguished guests, ladies and gentlemen, good morning. It is a real pleasure for me to open this virtual conference on major trends in the financial industry. I would like to thank the organizers, IF Expo, for their kind invitation. We are at the doorstep of 2021, and uncertainties about the medium and long-term economic consequences of the COVID-19 pandemic are still very high, and the stability of the market environment continues to be fragile. Regulators and financial institutions alike are still dealing with the effects of the pandemic. Sharing knowledge is of a critical importance during any crisis, so we can learn from each other's insight and experience. To help mitigate the impact on the pandemic on the financial system, CySEC has been in constant communication with ESMA and the national supervisory authorities across the EU, assessing the immediate challenges and the long-term impact to the financial industry and the economies. It has been an opportunity to come together, the lasting impact of which will be one silver lining of what has been a difficult year for so many. Cypriot investment firms, the CIFs, encountered dramatically increased and prolonged volatility in the markets. Robust systems, adequate technology, and prudent risk management are very important during such turbulent periods, both for the resilience of the financial market, but also for the impact on the end investor. As it has done at the flash points in the past, unprecedented market activity has thrown investor protection into sharp scrutiny, as CIFs have had to provide for a big intraday movements, other increased trading volumes, and in some cases, liquidity concerns. The COVID-19 crisis has brought the role of technology into the spotlight. The need to digitize financial processes has gone from a nice to have to mandatory, as we all seek to work remotely, and digitization processes have been accelerated enormously this year. COVID-19 has showcased the value of IT and digital transformation. Those who have invested well in IT over recent years were better placed to ride out the current crisis, and hopefully this serves a wake-up call for the future. Overall, 2020 has caused a shift to greater interest in financial markets. Across the world, more individuals than ever before sought to engage with financial markets. Lockdowns proved conducive to individuals learning more about how markets work and acting to interest their own savings for the future. CySEC believes this is a positive trend when done in an informed way and when served by responsible providers, though. This year, traders were trying to navigate unpredictable markets, particularly across FX and contract for differences, which constitute a large part of CIF's business activities. In this context, some financial instruments related to European and US shares and indices that have suffered from low liquidity, exacerbated by European and US trading halts. Investment firms saw CFD spreads on indices and commodities increasing due to low liquidity. Spreads in FX did not quite witness the same extreme variations. More generally, the pandemic brought severe stress in capital markets, particularly for investment funds, focusing on liquidity issues, risking financial instability, and again, investors' protection. CySEC has closely monitored asset managers' activation of liquidity management tools since the beginning of the pandemic. This includes the suspension of redemptions, the use of gates, etc. Thankfully, asset managers in Cyprus did not need to use such tools. Market data shows that investors did not rush to exit their investments and cause fund managers liquidity problems. Partly, this is due to the prevalence of Cypriot alternative funds, which invest in less liquid assets under a longer horizon of investments and typically have a longer redemption notice. The small number of UCITS funds are the exception to this, and as we look ahead, to the period of economic recovery and a harsher picture of economic confidence, liquidity management is an issue we will continue to keep a close eye on. Like the global counterparts, the Cyprus Stock Exchange reaction to COVID-19 was worryingly volatile. The index fell around 20% from March to November. Listed companies in the tourism and banking sector were especially impacted as investors prepared for prolonged weaker revenue generation, higher loan provisions, higher MPhils. All listed companies were called by CySEC to inform the market on the impact of COVID-19 on their business activity. Naturally, there was an immediate impact on the turnover of listed companies in the tourism area, especially in the retail trade sector, as operations were suspended to limit the spread of the pandemic. The turnover of listed companies from other sectors was affected indirectly too. The current environment results in an urgent need to support the recovery of the European economy. As in the aftermath of the 2008 crisis, we must rebuild back stronger with reform processes, better supervision, and more resilient operations. It is time to come together and accelerate the projects that underpin collaborative growth, notably creating a deep and efficient European Capital Markets Union, the CMU. A more developed CMU is key to funding the post-COVID-19 recovery. Government support can only get us so far. We need the support of the capital markets to complement public funding and bank funding, both under pressure from the pandemic. A CMU would improve and diversify funding conditions, creating prospects for jobs and growth, including a more sustainable and digitalized economy. There are still several obstacles to overcome on the path of completing the CMU. Progress is still needed in many key areas, notably like harmonizing taxation, corporate insolvency regimes, but specifically moving towards more supervisory convergence among the national regulators armed with similar proactive supervisory practices and sufficient resources. Success in these areas would mean more cross-border investments without barriers, lower administrative burdens, and lower funding costs for companies seeking international investments. The Wirecard case has once again highlighted that high quality, robust, and sound financial reporting is essential for the effective functioning and integrity of the financial markets and for maintaining investor trust. It also highlighted the need for effective supervision and enforcement of financial reporting across the EU. Achieving similar supervisory outcomes in this area are indispensable for the development of an efficient CMU. Moreover, better developed and integrated euro area capital markets would strengthen the international role of the euro, as well as building a stronger European financial sector to meet the emerging challenges created by Brexit, particularly in areas where the EU currently relies heavily, like the UK financial centre. It is a miracle I have got this far without Brexit being mentioned. Unfortunately, it is increasingly becoming evident that we will have a no-deal Brexit, which means that as of 1st of January 2021, the UK will have to be treated as a third country. CySEC is prepared for any possible Brexit scenario and is party to the Brexit Memorandum of Understanding, MOUs, which have been agreed by ESMA on behalf of all member states, the FCA, and the Bank of England. The MOUs were prepared in anticipation of a hard Brexit last year, but will be valid at the end of the transitional period. They will ensure that cooperation between CySEC and other national competent authorities and FCA will not be affected, that investor protection will not be put at risk. It is our collective aim that collaboration between CySEC and UK regulated entities will not be disrupted to the greatest extent possible. We have issued on our own website a number of communication on Brexit issues to provide as much information as possible. The signing of the aforesaid MOU will suffice also for the seamless continuation of the resourcing arrangements that are in place between Cypriot fund managers and UK firms, as the existence of such an MOU is a prerequisite under the IFMD directive for such outsourcing to take place towards third-country firms. Moreover, currently, there is also a significant number of UK firms providing investment services to Cyprus investment firms, acting as liquidity providers or otherwise. To avoid the impact of an abrupt end of these contracts on the market, CySEC will soon issue a guidance to the market participants and for UK firms who wish to solicit Cypriot professional clients and eligible counterparties to establish a physical presence in the Republic. Finally, on another note, I'm encouraged to see that COVID crisis has increased the focus also on sustainability. There is a lot of discussion and momentum on ESG, sustainable banking, sustainable finance. There is clear consensus that we need to rebuild our economy and financial structures in a more sustainable way than before. We have seen an uptick in EU legislation aiming to tighten disclosure, designed to facilitate the shift towards the EU transition to a low carbon dioxide, more sustainable, resource efficient economy, and which form part of the sustainable finance agenda of the EU Commission. In Cyprus, we have already registered some alternative funds with an investment policy focusing on environmental, social, and governance factors, which is promising. We are yet to see a large-scale shift towards responsible investments, but we are moving towards the right direction. Disclosure regulation will apply from March 21, with taxonomy applying gradually from January 22 to 23, at which point I expect a sharp acceleration towards more responsible investing. The latest data gathered from asset managers in Cyprus showed that 34 million of funds under management out of 8 billion have a sustainable investment strategy. The taxonomy regulation sets the criteria for what is considered as an environmentally sustainable economic investment. So, for a fund to be considered as an ESG fund, from now on, it must firstly comply of what is provided in taxonomy regulation, which determine what is considered truly sustainable in the EU. This is an important step in clamping down in what has become known as greenwashing, allowing investors to make an informed decision on factors of environmental performance and social equality. These developments sit well in the pre-COVID macro agenda, the goals set by the Paris Agreement and the 2030 Agenda for Sustainable Development. The role of private capital in making these goals is instrumental. A meaningful component of the billion or trillion euros of assets under management need to be directed towards sustainable investments. Public finances alone will not be able to make this transition. That is why, from our part, we need to take sustainable investments. We need to make sustainable investments attractive and provide whatever incentives are necessary to asset managers to consider these options. These may be tax incentives, capital requirements easing, and maybe an efficient licensing process. We will also actively support firms and entrepreneurs who are developing greener fintech solutions that seek to automate and enhance analytical capabilities of firms to handle ESG information under our Innovation Hub. Concluding, I would repeat the thought I shared with you at the beginning. After the previous crisis, 2008, we took significant steps to make our financial system more resilient. In the face of another major crisis, we need to take similarly bold steps. We need to fulfill our commitment in building a fully fledged capital markets union. We need to foster investor participation and greater cross-border investment, thereby boosting the productive use of capital and diversifying the sources of funding needed for financing the recovery and the transformation into a greener and more sustainable economic model. The need for good, robust financial resilience is more important now than ever. And I am in no doubt that we will face a challenging and transformative next few years. With these thoughts, I would like to thank you all for your kind attention, and I wish you a fruitful rest of the day. Thank you very much.